Hey, what's going on, guys? It's your boy Freddy. Welcome back to the channel. If you guys remember, this time last year, Air Canada's business was absolutely destroyed by the illness, and it looked like the company was headed for its second bankruptcy in less than 20 years. However, now the stock is up over 120% from its March 2020 lows, and the question arises, is the company back on track, or is this stock price completely unjustified? Let's find out. For those of you who don't know, Air Canada is Canada's largest airline and the largest provider for scheduled passenger services in the Canadian market, the Canada-US transborder market, and in the international market to and from Canada. In 2019, Air Canada carried a record 51 million passengers, offering direct passenger service to nearly 220 destinations, and 2020 was set to be another record-breaking year, pushing the stock price to even higher all-time highs. Before everything dropped off a cliff for Air Canada, they were a profitable business and owned over 50% of the Canadian airline market. They also made big investments with the purchase of Aeroplan, which is a travel rewards company, for $500 million, and also bought Air Transat, a competitor to Air Canada, which we will further explore later in the video. However, through all of the potential success that was coming Air Canada's way, the illness had other plans and absolutely decimated the travel industry, causing air travel to drop more than 60%, and research shows that it will take multiple years until we see normal levels of travel again. I'm going to show both the positives and the negatives for the company and see if we can come to a conclusion on the future success or failure for Air Canada. Let's take a look at the recent annual report to see if we can get a better understanding of the financial well-being of the company. Looking at Air Canada's income statement, we can see the biggest issue plaguing the company, and that would be the extreme lack of revenue. With multiple flight destinations being grounded and government regulations stopping the majority of international flights, we see that Air Canada's revenue have dropped 70% compared to their 2019 levels. They've drastically cut expenses, but they were not enough to mitigate their substantial loss. One of the biggest issues was that they are still spending 70% as much on salaries as they were from the year prior, and this is in spite of the fact that they laid off and furloughed a major portion of their workflow. Another point of interest is their depreciation and amortization. Although their planes are sitting and not being used much at all, they are still subject to almost the same depreciation and amortization as they would be if they were flying regularly. All of this resulted in a net income loss of $4.6 billion or $16.50 a share, which is absolutely brutal. Taking a look at their assets, we can see that they have worked hard to increase their liquidity, and this resulted in a massive increase in both their cash and long-term debt liabilities. This to me was an essential move by the company, as their current burn rate, or cash that they are using every day, is almost $13 million, and annualized that's about $4.8 billion. They've also sold and leased their new 737 MAX planes to raise an additional $500 million, and also had a share offering which raised $850 million. This share offering was a great move in the long run, as they were able to take advantage of their increasing stock price, and they desperately needed the cash. All of these methods of generating cash have led them to have a current ratio of 1.2, which basically means that over the next year or so, they will be able to cover all of their liabilities with their current cash levels, which is a great sign. Looking ahead at the future of the company, we see their pending deal to purchase Air Transat is still in the works. This deal was initially announced in 2018 and at the time was valued at $500 million, but due to the illness, this has dropped to around $200 million. Personally, I don't think that this is the right time to go through with this purchase. Even though they are getting a huge discount due to the illness, I believe that currently they are running an extremely lean operation and need to hold on to cash as tight as they can. Acquiring another struggling airline who are not even flying at all right now is very risky. If they are able to hold on and ride out this next year and we start to see a return to travel, this could prove to be an amazing move, as it would increase their market share and further increase their dominance over the competition. The next 3 to 6 months are absolutely crucial and would dictate the type of recovery the company will have. If vaccine distribution goes well and we start to see signs of increases in travel, then they should be fine in the long run. However, for whatever reason, if we don't see increases in travel, I believe that the road to recovery will be much harder for the company. I have been in the stock since around May and have a cost basis of around $19. However, I'm not going to be adding to it anymore, and I'm actually trimming my position and looking to exit the company completely. Even before the illness, when they were having record growth, they only had around an 8.5% profit margin. Personally, I don't want to be a long-term investor in an industry with tight margins like that. With over $19 billion in revenue, finishing with an operating income of $1.5 billion is quite underwhelming for me. I believe that the stock price is pricing in a return to normal quicker than I think will be the case. Even if they can get back to their previous revenue levels in the next year or two, they now have an additional $5 billion of debt and ticket refunds that they'll have to pay down. This will of course dampen profits for many years to come, and I think it will take a long time before we see numbers like we saw in 2019. I do still think that there is a lot of value in this company and they have the potential to see massive returns, but just for me personally, it's not worth the risk to reward. Well, that is my analysis on Air Canada stock. Let me know in the comments down below what you think of the company and if you're invested in them. Remember to hit that like button down below, as it really does help the channel to grow, and consider subscribing for more investing videos like this to come. I also have a Wealthsimple referral link in the description that gives you $10 when you deposit and trade with 100 or more, which is an instant 10% return on your money. I'll catch you guys in the next one.